Successful trading requires a departure from emotional decision-making. The SP2L strategy uses a rules-based checklist to identify and execute high-probability setups. This system operates within specific parameters. You will analyze the market on a 5-minute timeframe, execute on a 1-minute timeframe, and limit your total capital risk to 1% per trade. You will learn two primary skills: how to identify the exact candle that triggers an entry, and how to use mathematical scaling to manage trades that move into a drawdown. Adhering to this mechanical process replaces subjective bias with a repeatable set of instructions. By following the checklist, you ensure each trade is executed according to the system's logic rather than impulse. Begin your setup on the 5-minute timeframe. This allows you to observe the market's broader direction over the current and previous trading days. Locate and mark the highest and lowest price points reached during the previous day. These levels serve as your primary structural boundaries for the current session. This chart includes a 60-period exponential moving average, or EMA 60. The EMA 60 tracks the average price over the last 60 candles, placing more weight on recent price action. We use it as a dynamic level of support and resistance. Next, draw a trend line by connecting the sequence of highs or lows. This provides a clear visual map of the current market trajectory. The SP2L strategy follows a golden rule. Every trade must align with the direction of this trend line. In a downtrend, you only seek sell positions that remain below the trend line. This filter ensures you are trading with the path of least resistance rather than fighting the market's momentum. Once you have confirmed the 5-minute trend, drop down to the 1-minute timeframe for execution. Look for leg 1. This is a sharp, aggressive price spike moving in the same direction as your macro trend. For leg 1 to be valid, you must see vertical gaps between the wicks of the candlesticks. This confirms that the movement is high velocity and driven by strong momentum. You must wait for this aggressive spike to complete its initial move. Do not attempt to enter while the spike is still actively forming. The entry trigger is a single candlestick that breaks exactly 1 pip against the spike. A pip is the smallest standard unit of price movement. In a downtrend, this means a candle high that sits 1 pip above the previous candle's high. The exact moment this 1 pip break occurs, you open your position in the direction of the original trend. This 1 pip counter move marks the technical end of leg 1. Entering here allows you to position yourself for the start of leg 2, using the established momentum of the first spike. Immediate risk management is mandatory. Your stop loss is placed at the absolute origin of the leg 1 spike. Your take profit is set identically. With a 1-to-1 risk-to-reward ratio, your target distance matches the distance to your stop loss. You must calculate your position size so that the distance to your stop loss represents no more than 1% of your total account balance. Defining these mathematical targets before the trade progresses removes the need for mid-trade decisions. It ensures your capital is protected by a preset exit strategy. If the market tests your position by pulling back toward the stop loss, the strategy uses a scaling-in approach. The 2x method is triggered if the price reaches the 50% mark between your entry and your stop loss. At this point, you open a second position in the same direction with double the volume of the first. Alternatively, the break-even gap method uses the candlestick gaps identified in leg 1. If the price pulls back to these gap zones, you open an additional position with increased volume. Regardless of how many positions you open, your original stop loss and take profit levels must remain exactly where they were set at the start. Adding volume at these pullbacks improves the average entry price of the overall trade. This creates a path to reach the profit target or the break-even point, even if the market does not immediately move in your favor. The process is complete. You have filtered the trend on the 5-minute chart, identified the leg 1 momentum, and executed on a 1-pip counter break. Practice identifying the specific gaps and triggers in historical data. Learning to spot these setups without hesitation is the first step towards consistent execution. Following this checklist allows you to execute trades based on objective market conditions. By removing the need for intuition, you can focus on the disciplined application of the strategy.